Very good afternoon, good morning. Welcome to FX Week Ahead live market analysis with myself, Giles Coghlan. I do hope everybody's doing well. Special welcome to you, Alejandro. Good to see you. CN, good to have you back. Kingsley, pleasure. Massi, Nahar, Philip, welcome. I think this may be your first time. Sammy, good to see you. Yasser, oh, great. Just as the folks are coming into the webinar, don't forget we are looking at different entries, exits, potentially different instruments for trading. None of this is a signal trading service. I'm just outlining my trading approach and what I'm looking for the coming week. It's not meant to be investment advice. Those of you who are regular know how this webinar works. Don't forget you can ask any questions as we go through the webinar. Just pop them into the chat box or the question box. And it's always a pleasure to hear from you and your points of views. So any comments, questions, please do pop them in. I will get to them definitely at the end if I don't address them as we go along. Main topics we're looking at today, China growth. I am quite interested in China. I just want to run through the medium-term bullish outlook for China's stocks. Probably not the best timing, but we'll look at ways we could potentially manage that. And I'll show you how I'm looking at managing that. I've got a long position on China's 50. I'll explain to you what I'm looking at there going forward. And Aussie dollar, got the RBA rate decision coming up, got the ECB decision. 3 central banks meeting this week with the Bank of Canada as well, so we'll be running through those. Also ECB, key point for the euro and the dollar yen. It's been a real big driver on those 10-year yields, and we've got US PMI data coming up this week, and that's likely to be a big mover, particularly if we get a miss. So I'll run through that with you. As long as gold and silver, I am expecting gold and silver to turn higher at some point. The outlook is still bearish for gold and silver, but when they do turn, there could be a really fantastic opportunity in silver. I want to run it by you so you're completely up to speed with how to manage it. Okay, folks, without further ado, let's jump into the webinar, and I'm going to go and have a look at the calendar. That's the best way for us to start today. Now, today, Monday, sentiment's mixed out there in the market, and this makes sense. We have let's just get the data in from last Friday as well. We had the NFP data coming in last Friday, and as you can see, it was pretty good. So headline, 315,000. Average hourly earnings a little bit down, and we got weekly hours a little bit down, unemployment rate a little bit up, so participation rate a little bit higher. So on balance, a more positive report. Employment's still strong in the US. So as a consequence of employment still being strong in the US, that means expectations are still on track for the Federal Reserve to be hiking interest rates aggressively. And we can see here that the dollar yen has continued to track. It's a little way higher, and we can see on the 1 hour chart, just saw price breaking out that little symmetrical triangle pattern that we had earlier in the session, just breaking higher and making its way ever so slowly up towards that R1 resistance. No trade here, but the bullish bias is still in play. And if you just track the 10-year yields, you see that when the 10-year yields rise, that moves the dollar yen. Now, the reason that's the case is because the Bank of Japan have kept interest rates so flat. So all we have to look at is the path of the dollar yen, all we have to look at the path of US 10-year yields, and that tells us what's happening with the dollar yen. So interest rate expectations are what's pushing the dollar yen higher at the moment. The last Friday jobs data report confirmed that the Fed, look, they can still be more aggressive hiking interest rates, and we can see short-term interest rate markets, 87% chance of a 75 basis point hike expected for the 21st of September. Now it's US Labor Day on Monday, so look out for pretty slow price action throughout the rest of the session from now heading into the Asia session. So things shouldn't really pick up now until tomorrow. The only thing I would say is when you have lower volatility markets with the US being out, sometimes you can get large moves because there's gaps of price where there aren't the normal amount of orders. So it means price can sort of skip through areas. Now that works particularly in the situation that you get price skipping through, particularly in the situation where you have unexpected news. So if you get unexpected data or unexpected news, that can disproportionately cause markets to move significantly higher. So watch out for that. Tuesday, we've got the RBA interest rate decision coming up overnight. Now, you can see that markets are expecting a 50 basis point rate hike. Now, I was selling the Australian dollar, New Zealand dollar from last week into this event, and I'll explain to you what you can still look for. Now, the RBA is expected to hike interest rates by 50 basis points, okay? And you can see here that the Aussie is just pulling down. I was expecting the RBA to pull down because I'm not expecting the RBA to necessarily be very hawkish. And you can see the Aussie New Zealand dollar pulled up into that overhead resistance with a rejection of the 200 exponential moving average on the monthly chart. And I was expecting a higher likelihood of a dovish RBA than a hawkish RBA. And if you look at the bond yield spread, you can see that the bond yield spread was pushing lower. So that gave me the conviction to sell. And as well here, you can see I have a Harami inside bar, false break, rejection of that level. And you see on that intraday trading bias, you see that intraday potential trend line was broken lower last week. So selling from that level, stops above the high, just made sense, right? So I'm short Aussie New Zealand dollar, shorting from up here. I'm going to take 50% of the position off today, and I'm going to leave 50% of the position to try and have a run down lower. Now, if we get a dovish RBA, and what to look for from the RBA is if they start stressing growth concerns. If you look at their last labour data point, which came out in the middle of August, what you'll see is that the Australian data was, I'm just going to look at the other, let's just look here. So I think it was around this time in August, have a look. Yeah, you see the labour data. Headline, big miss, minus 40,000, and full-time employment, big miss, 86,000. So part-time employment gained, but the full-time employment, a big drop. So on top of the PMI data, flash into contractionary territory, composite PMI into contractionary territory. So we may see a more dovish RBA. Now, I'm not selling the Australian dollar now. Okay, and I'm booking the profit because it's not. Yeah, that's right. I see it. It's a little late for an Aussie New Zealand dollar short now. Right, absolutely. Okay, but if we get a more dovish RBA tomorrow, and you come to your desk, look for intraday Aussie New Zealand dollar shorts. Okay, and so look for selling from any retracements higher on daily pivot points, and look at this 100, 200 exponential moving average. Maybe if we get those lows broken, you look for a retracement back up to that 1.132 region. So even though it's don't short it now. It's just too much of a risk. The risk reward doesn't make sense. Okay, if you're already short, close something out and get it booked. Now, this is the ISM non-manufacturing PMI data. This will be important for the dollar yen. Now, I've shown you how the dollar yen tracks US 10-year yields. So what we're looking for, and we can see 10-year yield just pulling down a little bit lower here today. If we just look on the daily chart, we can see that let's just make this a bit prettier, just moved up into that overhead resistance level. US 10-year yields pulling a little bit back. Nothing to note here, nothing significant, just a natural pullback from resistance area. But the ISM data tomorrow will be important. If we get a big beat above market expectations, expect this pair to move higher, and I'll be looking at buying dollar yen. If we get a big miss, I'd expect any yields to drop lower, and I'd look at going long the yen via the pound. So pound yen shorts. Now let me show you, or maybe euro yen. So expectations, if it comes in above 57, then that will be dollar yen long. If it comes in sub 53.5, I'd look at pound yen short. And if you look at the pound yen, you'll see that there's a very, very nice technical setup here. You got a double symmetrical triangle, the big symmetrical triangle mark there, and a smaller symmetrical triangle. And the way you'd use it is we're looking to short this market. The yen has been very, very weak recently. And you can see the weakness of the yen has allowed the pound to be supported against the yen, despite how weak the pound has been. And if you just take a look at the basket of the pound, you see how weak the pound's been since like the middle of August, after the Bank of England increased projections for a 15-month recession for the UK, recession projections brought forward from 2023 to 2022, cost of living crisis, Brexit concerns, worrying, concerns over what PM Liz Truss would be like with Boris Johnson leaving, yada, 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 all resulting in pound weakness. Now, again, don't want to chase this now lower because there's a lot of bad news priced in. But, and it's similar with the euro, you see, if we get a big miss in the ISM data, we'd expect the yen to strengthen. So pound yen selling makes sense. Use that trend line, I will, to manage risk, okay? So I just break below that, stay in the market. If you get back above that trend line, exit. Similarly with the euro yen, but exactly the same opportunity. And I'll just show you that. Now, if you look at the euro, you see again, the euro has been heavily sold off. Russian-Ukraine crisis, surging energy prices weighing on German manufacturing. The last IPO German data, German manufacturers are expecting to pass on increased costs to consumers. We had levels in the Rhine dropping, making transport difficult to the heartland of German manufacturing. And remember, Germany is the driving force of Europe. So a slowdown for Germany means a slowdown for Europe. But we've recently seen a little spike higher in the euro on expectations of more aggressive interest rate hikes from the ECB. But any yen strength, we'd expect that to really send the euro yen lower. Notice we had this move up into this overhead resistance, big supply area. Now I took a bit of a short here, a bit speculative it was on Friday, and I've managed to get in about 140.64. Notice we're holding this trend line here. So this is not something to trade now. There's no trade here. Naturally, we're finding a bit of support at this level. I'm just trying to hold through that ECB meeting. Now, if we get back below here, so should we get a miss in the ISM data, you'd expect the yen to strengthen and the euro yen to move lower back towards that 137.73 region. So pound yen, euro yen, both make sense if we get a big miss in the ISM print. A beat, dollar yen upside makes sense. Then we have Australian GDP data. Now, interesting, if the RBA stress growth worries, and then that shows a growth rate below minimum expectations, expect that to wear in the Aussie, and Aussie New Zealand dollar downside would be the best way to express that, for sure. Eurozone growth rate, don't expect that to move markets much. Got the Canadian Bank of Canada interest rate decision. This will be interesting, right? So they're expected to hike interest rates up to 3.25. So 75 basis point rate hike is expected. If we just check STIR markets, what we see is 94% expectations for 75 basis point rate hike. Now, if you just take a look at the Canadian dollar, what you'll see, just take a look at the basket. What you'll see is there's an awful lot of strength priced into the CAD. See how the CAD's been gaining. Now, at some point, we're expecting a little bit of a pullback here. I'm sensing the CAD's quite close to peak hawkishness. So if we get a surprise and we get any kind of dovish response to the Bank of Canada, and remember, Canada's biggest trade partner, the US, is starting to show signs of slowing growth. And remember, one of the big influences on CAD is oil. And you can see here that, you know, when oil prices gain, that tends to support the CAD, right? See the correlate? Rising oil, rising CAD. Falling oil, falling CAD. Rising oil, rising CAD. Falling oil, falling CAD. And oil is having a little pickup today on expectations that OPEC Plus are going to have 100,000 barrel per day in production cut. That's just helping oil up today, it's helping CAD. But when we come to Wednesday, and like any kind of surprise, any kind of dovish surprise, I'd expect CAD weakness. And you could express that against the US dollar. So US dollar CAD longs could make sense. Another opportunity would be against CAD Swiss franc. The Swiss franc is also an inflation hedge, and since the Swiss National Bank had changed their outlook for the Swiss franc, no longer seeing it as highly valued, starting to hike interest rates, it's not a massive surprise that we might be able to see CAD Swiss franc selling on a dovish Bank of Canada. So I think that's what I'd be looking for. You know, and I'd look at, let's have a look. I had an attempt at selling the CAD Swiss franc last week. Now I'll show you when we had a little bit of a higher inflation print from Switzerland. I sold around this level, took one clip off of that as we moved lower. Then when we re-entered, I entered another clip lower, but then you see price just moved up and it kept moving higher, and in the end I closed the trade. I didn't like the way the trade went, and I would have had my stop taken out anyway, right? But there is a medium-term sell bias for the CAD Swiss franc. But what I'd want to see is a more dovish Bank of Canada, and if we got that dovish Bank of Canada, what you could do is you could just use this line here as a potential trend line. Now I know we had that penetration, that was on that Swiss employment data, right? Sorry, the Swiss inflation data last week. So it looked like we're going to have a good run and break at that level. Now I just keep that trend line in place. But if we got a dovish Bank of Canada, go with the break of that trend line is what I'm going to do. And then keep my stop above the low and see if we can start running back down towards these lows. Okay, so that's what makes sense. But we have to have a disappointing Bank of Canada meeting. And that, you know, just watch the reaction. Just because you get 75 basis points rate hike is not going to be enough to move markets. Right, now just while we're looking at China 50, I want to show you this. Now, broadly speaking, if you take a look at the China 50 index, you see this very nice trend line going from 2014, right? Now, that very nice trend line is supportive technically, and we've had a test of that trend line. Now what's been weighing on China, and you can see China's 50 has pulled back from 2021, it's pulled back like 40+%. So unlike some of the other world indices, the People's Bank of China is looking at cutting interest rates. Now, the reserve ratio requirement was cut today for Forex by 200 basis points. So there's a whole raft of stimulus packages due to support China. We can also see on the weekly chart, we have this huge reversal candle here. Okay, so that's massive support in this level. So stops can be very tightly placed underneath 12,000. That's where my stops are. I've got a medium-term position. I'm expecting China's 50 to recover. At the moment, sentiment is negative. And the reason it's negative is you've got China's zero COVID policy. That's the policy where, you know, you get some cases in the city, they shut the whole city down. It really cramps economic activity. Markets hate it. We've also got struggles in the property sector. We also have, despite lots of stimulus, pretty muted response from China's GDP growth, which is continually being revised lower. So all those factors are weighing heavily on China's 50 index. Plus, you've got sentiment pretty negative throughout the world on the rest of the central banks around the world hiking interest rates, expected to cramp demand globally. China's also a major manufacturer, so slowing global demand also weighs on China. So there's not time to get in, but one potential of getting in would be just taking a long on a key trend line break. So what you could do is just have that trend line there, potential trend line. If that trend line breaks to the upside, go with the trade. Okay, that's one way of getting in it. Okay, If a trend line breaks the upside, go with it, go long. If it goes back below, close your trade. That's one potential way of getting into this 50 index. And look out for signs of more stimulus, more support. But at the moment, it's not really lifting sentiment very much, even though sentiment's lifted a little bit today. And that was on the Chinese private PMI data that came in overnight. Do you see the private PMI data? 53. So the Caixin is the private companies in China, smaller, medium companies. And you can see the services PMI in expansionary territory, both above forecast, both either close to or just a little miss from the prior. Bottom line, that's good, and that's been supportive not only for China's 50, we've also seen that supporting commodities. You can see iron ore prices, a little bit of an uptick, coal futures and copper, just a little bit of an uptick. Not much, but enough. So that's what's going on there with the China's 50. Then get to Thursday, lovely ECB day. Now, markets are expecting a significant rate hike, expecting it to go up to 25 basis points, up to 0.75%. Now, if you just look at the projections, you can see that a 50 basis points rate hike is 100% priced in, and 75 basis point is nearly 100% priced in. So the economists are not pricing enough in to the forecast. So what we want to see here is what the growth outlook is for the ECB. The hike itself, yeah, it might have a short-term reaction, but what we want to see is the ECB looking at raising the terminal rate? In other words, what I mean by the terminal rate is where do they see the interest rate going in the future? So at the moment, you can see markets are expecting interest rates to go up to 1.6% from the current rate of 0.00%. Okay, so expecting a change by 75 basis points expected. Now, if they drop the terminal rate because they're seeing a euro recession, then that could sink the euro, even if they end up hiking by 75 basis points. So the focus is going to be on what the ECB projects going forward. So don't be sucked in by the headline. But if they disappoint markets and don't hike by 75 basis points, so 75 basis points, that is expected, and it was a 50 basis point hike last time. Please excuse me, I got confused there. It's 75 basis points expected. So the economists are in line with short-term interest rate markets. So if it comes at only 25 basis points, then that would be more negative for the euro. And so you could expect something like euro pound selling. So I'd be looking at selling the euro pound on a disappointing print. So we just have a look here. And you can see the euro pound been tracking quite a lot higher recently, and a little bit, you know, this does look a little bit stretched, this euro pound. Right, very stretched, very sharp line, almost like a you know, a flag pattern going on. So what we're looking for, if we get disappointment from the ECB, then euro pound shorts make a lot of sense. And there's a lot of extension to the upside here. And if you just look at the bond yield spread between German bonds, right, and UK gilts, look at this. Do you see the bond yield spread differential? Do you see how price tracks the bond yield spread pretty close? And now look at the divergence. Bond yield spread dropping lower, euro pound higher. We got the new PM Liz Truss, who is now in a situation in the UK. She's been nominated to be the new Conservative leader and the new Prime Minister of the United Kingdom, and she's set to announce more kind of stimulus packages this week in an emergency budget. So that could lift the pound. So just watch out here for euro pound selling, and I would say, you know, any moves up to this kind of 0.8700 region really do look suitable for selling before the ECB, because risk could be nicely defined. So if we start getting up there, I would start thinking about having a few speculative shorts, just putting my stops above the 0.8750 handle, and just watch for a potential reversal. But again, it will depend on the ECB communication, so you've got to be careful with this. Make sure you manage risk. It's not one to sell now, but it's one that has a lot of potential for downside moving forward. Got Fed Powell speech, always important. Any indication that Powell is pausing rates or slowing the path of rates, expect that to weaken the dollar, and that'll be good upside for gold and silver. And looking at gold and silver, just remember what key drivers for gold and silver is the dollar and real yields, right? So when you get the dollar and real yields, blue is the real yields, purple is the dollar. When you get them both falling together, that lifts gold higher. Falling real yields, falling dollar, gold higher. Falling real yields, falling dollar, gold higher. When you get rising real yields, rising dollar, gold lower. Same for silver. So look at the moment, rising real yields, rising dollar on aggressive Fed expectations, falling gold. So if we get Powell indicating a pause in hikes, you'd expect the dollar and real yields to drop lower, and gold by proxy would rise. And silver would rise even more than gold, because if you look at the silver gold ratio, you can see that the gold silver ratio is very high, indicating that silver is cheaper relative to gold. So you can see in the candlestick chart, when the gold silver ratio is high, silver tends to have an outperformance. High ratio, silver outperforms. High ratio, silver outperforms. High ratio, silver outperforms. High ratio, silver outperforms. High ratio, what are you expecting from silver? Outperformance. Any signs of slowing Fed, any indication the Fed is slowing, not going to be hiking interest rates so quickly, pausing, any dollar weakness, any real yields weakness, expect silver to outperform. Gold, a potential catalyst, can be either the ISM data or it can be a dovish tone from Powell's speech. Then got the Chinese inflation rate. That can move markets. Nothing expected though, but just keep an eye on what the print is. And Canadian employment data, read that in light of the Bank of Canada interest rate decision. And then we've got Fed's Waller speaking on the 9th of September, use the normal playbook in terms of hawkish Fed or dovish Fed, and best expression would be the dollar yen. Right, great, let's get through some of these questions now. All right. Now, I have to apologize. Sometimes my control panel plays up. Ah, there we go. Plays up a little bit. Let me just see what I've got here. Okay, I'm just having a little look at the questions and answers. Okay, there we go. Right. Yeah, industrial commodities have been softening prices. CN notes about the Aussie. Yes, good point, CN. A lot of Australia's exports, for those of you who don't know, are iron ore and coal. So when iron ore and coal prices drop, that tends to weaken the Aussie. 2-year yields down recently. Yeah, good spot, CN. If ECB goes 75 basis points, is euro a short 1 hour later upon rally? That would be acceptable logic, CN. I would fade any euro strength, would be my go-to. Just keep stops tight and risk well managed, but fading euro strength does make sense. And I would focus on the terminal rate. Yeah, good approach, CN. Short pound CAD upon rally. Yes, that's a nice one as well. Yeah, in fact, that's worth looking at. So if we got like Bank of Canada meeting and we it would depend what the Bank of Canada do a little bit. Yeah, the level would be that 1.54. That's the best technical level that I can see, which is roughly that 50% move as well from the previous high. So that would be the overhead resistance there. I think shorting from there does make sense. Just keep stops nice and tight. Maybe use a fib point as your stop. So 50 basis point, maybe put your fib stop 1.5532 would probably make sense. There's a soft floor under oil, not bearish. I again would agree with that, with the OPEC production cuts. Structurally, there's reasons for more oil upside, and sadly don't like it with oil getting cheaper. There is pressure for oil to be closer to 100 than it is to be like 75. I think if you were looking at this, could this be a potential double bottom? Let's have a look. So you've got one, got the peak here. I would be looking for this. Does it form a double bottom, you see? So that peak to trough is what? Right, so that trough is 10%. These highs are within, if this is a level, they're within 5% of each other. So what that means, CN saying, and I think it's a good point, there's a soft floor under oil, which does make sense. Structurally, there is reasons for oil weakness. Now, if we get a double bottom here, so that's peak one, that's the trough, it's 10% from this peak, fine. That's a potential peak. So if this retraces higher, then we can look for a break of 98, maybe looking for a target up towards 107. What's the main event for the week? I think the main event for the week are the central banks. So it's like Bank of Canada, ECB #1, then Bank of Canada, then RBA, and then the US ISM data. Yeah, medium term, lower euro, exactly. That's exactly what I'd look at. Will euro be happy re Northern Ireland? The euro will never be happy re Northern Ireland. It's a very difficult problem to solve, and those Brexit woes continue to weigh on mainly the pound. I think the pound would be happy if the Northern Ireland situation was solved. The pound would be the better beneficiary. Yeah, I expected some mean reversion on the dollar. Be very careful of fighting the Fed, Abdi, right? I know some people have been expecting a retracement in the dollar for months, right? And look, if you look at the dollar, look how it's been rising since the start of the year. We just go over to like daily chart. So, you know, see what I mean? The dollar's been gaining since the start of the year. Safe haven inflows, aggressive Fed hike expectations. I don't expect any reversion in the dollar until we get some kind of signal of the Fed pausing, Abdi, right? So don't fight this. This is dollar strength. And this is also being supported by dollar yen strength. So the moment we get a more dovish Fed, then I'd look to play yen strength, and I look to play it against the pound or the euro. So that'd be pound yen shorts, euro yen shorts. Yeah, no, you're right. You know, it's such a thing. Don't fight the Fed. Don't fight them on the way up. Don't fight them on the way down. It's just stupid. They're the biggest central bank in the world, the biggest financial giant in the world. Just doesn't make sense to try to fade the moves. Are they getting close to peak hawkishness? Yeah, it feels like it, but it's felt like it for a long time. We need to see some deliberate shift in policy. And then the best way to play the dollar weakness would be via gold or silver, right? Because you expect the dollar to fall lower, real yields to fall lower as long as inflation remains depressed. Then I expect gold or silver to run higher, and that's what I'll be looking for, hopefully around September, October time, maybe November, even into December. But there could be some great gold and silver longs coming up in the next few months. So keep the powder dry is what I'm thinking, Abdi. Folks, been an absolute pleasure. Thank you all very much for attending. It's been lovely. Good to see you. I am coming back into Dubai around the end of September. So if you guys are around, it'd be great to come see you. Come and say hello. And when I see you, let me know you come to the webinar, because I may not, I don't get to see your faces, so I don't recognize you, but please do and come say hello to me in Dubai. Great to catch up with some of you guys who've been attending for years now, these webinars, right? It'd be nice to, spend a bit of time together. So thanks, everyone. Trading US dollar ruble spread about 23%. Yeah, that's one to leave on the sidelines for now, isn't it? Definitely, for sure, yeah. Folks, thank you very much. CN, thank you for your comments. Some very shrewd comments along the way. Thanks, everyone. Take care and have a very good session. Thanks, everyone. Bye.